Let's get you to the weekend. Live from New York City this morning. Good morning, good morning. Your equity market negative a third of 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, bond yields backing away from multi-decade highs, Middle East tension sending crude through 90, and UAW inching towards a deal with GM. We begin with a big issue. The Fed goes quiet.
What the Fed, I think, is trying to do is buy time.
Powell said in his remarks is the Fed takes the world as it is.
I don't know that there was anything particularly fresh in what Powell's had to say.
It's actually a pretty optimistic speech about how the economy is performing.
Not going to take another hike off the table.
We're going back to 2%. Like the Fed is absolutely capable of getting us there.
Focus on how long the Fed has to stay on hold.
The Fed keeps rate higher for longer until they get a recession.
The Fed's on hold until they see whether the economy slows as much as they anticipated.
Powell himself said he expects growth to be below trend.
If you see inflation sort of stagnate, stay at current levels, then the committee will conclude that they have to raise rates a bit.
The market's done some work for the Fed, but are we restrictive enough?
Even if they are on hold on November 1st at the meeting, high for long will still be an important part of the narrative.
Joining us now to discuss, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, always great to do this at the end of the week with you. We're entering the quiet period. That's the good news. No Fed speak for 2 weeks. Given what we've heard over the last few weeks, Mohammed, is that November meeting a live meeting still?
No. I mean, I think the market is absolutely right in thinking it's the minimus probability that we get a hike in November. You know, John, it's good and bad news that the Fed is going quiet. It's good news because that added to the instability. I was really intrigued yesterday during the event at the Economic Club of New York. When the speech was released, the 10-year went down below 490 and stayed there as Chairman Powell was reading the speech. And then when the Q&A started, it got crazy. We saw it go all the way up to 499 and then come back down. And it just shows you that right now, it's very hard to strike the right balance when you're talking about monetary policy. So it is a good thing that they are going quiet because that's a source of instability. But fundamentally, we need them to stabilize the bond market. The bond market is critical, as you know, for other markets, for the housing market, for the economy, and all this in the US and beyond. And we're not going to get stabilizers from the technical side. We're not going to get stabilizers from the economic side. So we desperately need stabilizers from the policy side.
Well, let's talk about where we've been. We were at 330 on a 10-year in spring of this year, following the collapse of a couple of big banks. Mohammed, since then, we've added about 170 basis points. The question we've had of Fed officials now for weeks is whether that's a substitute for further tightening. Haven't they basically said that it could be, or at least on the margin?
They have, but they don't quite grasp that there's a big difference between the market tightening the long end and they acting on the front end. And just look at the shape of the curve. Look at what has happened to U.S. 10-year yields relative to Germany. That differential now is at 205 basis points. It's almost double what it was 12 months ago. So yes, it tightens, but it also, and that's what the market is really worried about, it also opens a bigger scope for accidents, for something breaking. In fact, I'm quite struck by how often that phrase, something breaking, has been said on Bloomberg TV and elsewhere.
Well, let's get into that. The question I've asked a few times this week, Mohammed, I'd love your response to it. Do you think we fully realise the pain associated with the losses in the long bond? Not just in the Treasury market, but also in bonds, in gilts, worldwide?
We haven't, John. It still hasn't gone through the system. You know, this morning, the 30-year gilt is at a level we haven't seen since 1997 at 5.15%. There are people holding these instruments, and some of them have to be repriced, and there will be implications to that repricing. So we haven't. You know, the biggest risk, and you and I have talked about it, is that what has been relatively contained interest rate risk becomes credit risk and liquidity risk. That is the one thing we want to avoid. And the longer the instability in the bond market continues, the longer we lack anchors, the greater the probability of interest rate risk contaminating other risk factors, particularly credit risk and liquidity risk.
I don't mean to make this sound easier than it is, but don't we have an idea of the timeline for that, the calendar, given that we know where the maturity wall is for high yield out in 2025? Don't we have a decent understanding of that?
If it were just the maturity wall, yes, we do. Yes, we do. But what do you do with things that are stuck on balance sheets that need to be liquidated? It is very difficult to make the judgment as to when that is going to come out. It is very difficult to...
I think we've lost the connection with Mohammed. We're going to try and re-establish that. He's in the middle of his thoughts there about the prospect of forced selling. He mentioned gilts. Think about where they've been. If you look at the 2050 note that was issued back in 2020, so 30-year debt in the UK government bond market, that's trading in the 30s. That's a 60% move lower in the price of that bond. This is what we're talking about here. The losses in bonds are absolutely massive, huge in gilts, in treasuries at the long end. And this is something the Federal Reserve and Chairman Powell are thinking about too. Mike McKee's going to join us now to go through, Mike, a week full of Fed speak. I think we had a year's worth in a week going into the quiet period.
Yeah, I was going to mention to Mohammed, this is not the Fed blackout. This is the Fed brownout. There are 3 Fed speeches next week. They're on the payment system, so they're allowed. But you are going to have to pay attention to the Fed next week, too. Let's take a look at what Mohammed was talking about here. This is the 10-year, the circle on the left, when it broke down yesterday during Powell's speech when he said the Fed was going to be careful going forward and that they could take their time and they didn't want to go too far. And everybody sort of started pricing out any further moves. And then he came back a little bit later, and here's what he had to say. Additional evidence of persistent above-trend growth or that tightness in the labor market is no longer easing could put further progress on inflation at risk and could warrant further tightening of monetary policy. And then he said to David Weston, I think the evidence is not that policy is too tight right now. So that's when we got the other big jump up again. And now everybody is thinking, OK, not November, maybe December. Maybe we're going to be talking about rate increases down the road. And here's why. Look at the chairman says that we're worried about persistent up above 10 growth. Next week we get the GDP numbers. And as you can see, I showed this chart yesterday, the Atlanta Fed GDP Now and the Bloomberg Nowcast both have us above 5%. For the third quarter. That qualifies as persistent above trend growth. Then we'll have to see what happens going into next year. And that's the funny part, is when you look at what the expectations in the Fed funds market are, you can see that we have nothing for November, and then the market does expect rates to go up again. But then we hit 2024, and it's just one long series of massive rate cuts. It kind of tells you, John, after the end of this week, everybody who's spoken, and of course the chairman who's the most important, that nobody really knows what's going to happen going into next year. And you can't take any of these futures seriously with the possible exception of November because it's just around the corner. We're going to be adjusting to events around the world and the U.S. economy on a sort of day-by-day basis.
Oh, to have an outlook right now, Mike, is almost impossible for officials, for market participants. Mike, can you imagine an economist at the moment on Wall Street trying to put together a 2024 outlook in the middle of October?
Yeah. And this is the time when they're supposed to be doing it. I go back to the immortal words of the Hollywood screenwriter William Goldman, who once said, nobody knows nothing. And I think that's kind of where we are right now. And Jay Powell pretty much admitted that to David Weston yesterday. They don't have a lot of confidence in what's going to happen going forward.
A look into the next round of forecast towards the end of the year. Mike, thank you, sir. As always, Mike McKee, pleased to say we've re-established that connection with Mohammed. Mohammed, let's talk about the Fed's job going into next year. And at the moment, how do you weigh this bond market sell-off, the tightening that's in the pipeline already relative to the incoming data? You've talked a lot about how hypersensitive this Fed is to incoming information and the lack of a strategic view looking out beyond November, beyond December. What needs to take place now?
So I think they need to pivot from excessive data dependence to data dependence that has a greater forward-looking component. And that's what I was hoping would happen this week, and it hasn't happened. So we are going to remain in the situation of great uncertainty because there is no vision as to where this economy is going. And remember, John, it's not just about the uncertainties to do with financial accidents with the economy. It is about the serious debates, and Chair Powell referred to it. Where's our start? What are the lagged effects of monetary tightening? What about QT? What about the monetary policy framework that's outdated? So there's a lot of things that need to be discussed and fixed in the Fed complex.
Is it a mistake to address that with any kind of vision, Mohammed, when you just don't know? What do you say?
You've got to have a vision, John. You cannot drive a car without some understanding of what the road ahead looks like. You can't just look at the rearview mirror and try to adjust to every curve you just had. That's not how you drive policy. And it's certainly not how you drive policy when the impact of policy happens with a lag. So yes, you've got to have it. This is the first Fed I know that hasn't gotten it.
Well, let's go one step further, Mohammed.
Feds,
what would your vision be?
So my vision right now, as you know, is that we live in a world where the supply side is a problem. We're living in a world where the US economy is weakening. Therefore, be careful of too much hiking. That's the balance of risk, excessive hiking. We still have the lagged effects in the pipeline. We still have the QT effects. So I would make it very clear that I'm unlikely to hike unless I am surprised in a very big way by the lagged effects not happening. I would also add that we need to have a discussion about the path to lower inflation, because there's a risk that if we try to get to 2% too quickly, we are going to break something in the economy and something in finance because we're not relaxing the supply side problems.
Mohammed, always appreciate your perspective. The good news, no more Fed speak after Saturday, at least for a week or so. Mohammed Al-Erin, a good friend of this programme and a good friend of mine. The latest from Bank of America. Fed commentary has all but confirmed the Fed will stay on hold in November. We shift the last rate hike in our forecast out to December. November is dead. Apparently it's long-lived December. Let's get you some movers going into the opening bell. Here's Abby.
Well, John, we are looking at a down week for the S&P 500, down more than 1% at this point for the E-mini futures. And we're ending the week on a down tone, with futures being down a little bit. Tesla, after that disappointing quarter in color, down once again, down 1.6%, also having to do with possible China exports and reflecting the bit of a risk-off tone today for stocks. Intuitive Surgical, I was about to say iSurge, that ticker down 5.3%. Third quarter revenues missed. Lots of price targets cut, but the big laggard on the day, John, SolarEdge, absolutely plunging, down 29%. They pre-announced to the downside for revenues on delayed orders. Some of the other solar companies, such as First Solar, Sunrun, down in sympathy. There is a 12% short interest into today, John. This stock down 60% year to date on the open. It's going to be absolutely brutal.
iSurge is a better name for it anyway. Abby, thank you. Coming up, President Biden addressing the nation.
Hamas and Putin represent different threats, but they share this in common. They both want to completely annihilate a neighboring democracy, completely annihilate it.
That conversation up next with Crossmark's Victoria Fernandez, George Goncalves of MUFG. That's next. This is Bloomberg.
Hamas and Putin represent different threats, but they share this in common. They both want to completely annihilate a neighboring democracy, completely annihilate it. Tonight, there are innocent people all over the world who hope because of us, who believe in a better life because of us, who are desperate not to be forgotten by us, and are waiting for us. But time is of the essence.
The president addressing the nation, making the case to fund both Israel and Ukraine. A roughly 15-minute Oval Office address setting the stage for a formal request to provide $100 billion.
American values are what make us a partner that other nations want to work with. To put all that at risk if we walk away from Ukraine, we turn our backs on Israel, it's just not worth it. That's why tomorrow I'm going to send to Congress an urgent budget request to fund America's national security needs, to support our critical partners, including Israel and Ukraine.
Team coverage starts right now with Bloomberg's Ollie Crook in Tel Aviv, AMH in Washington, D.C. Ollie, good morning.
Yeah, Jonathan, the main focus today is going to be the escalation risk and risk of spillover. Friday, another day that's been called a day of rage for Hamas. Protests across the Islamic world is what is being called for at a time when Israel continues to strike within Gaza, continues to strike targets in southern Lebanon, and at a time also when we're seeing the U.S. saying more activity on their installations in the Middle East and also intercepting apparently cruise missiles and drones from Yemen going up the Red Sea towards Israel. There's the small matter of a large nation that sits between Yemen and Israel. That is Saudi Arabia, which obviously has a very, very large stake in this, which takes us to the Arab leader meeting that is happening tomorrow in Cairo. We understand that that will be attended by Mohammed bin Salman, the president of Turkey, as well as emissaries from the Western world, and namely Europe, a number of foreign ministers there. And we say that as well, waiting for this ground incursion that could be the next catalyst for something serious. And of course, Jonathan, now 14 days into it, 2 weeks, the aid still sits at the southern border of Gaza with Egypt.
AMH, let's build on this. $100 billion. What's the response in Washington?
Well, Jonathan, there's a lot of bipartisan support when it comes to aiding Israel. But what you see in this $100 billion package, what the president said last night, today, that he will be requesting that urgent need to Congress, is the fact of the matter is that this is a number of issues the president wants to make sure is in this supplemental package. It's not just about aiding Israel. It's also about aiding Ukraine. The president yesterday really tried to link these two parallel conflicts and drawing this appeal to the American people on why it is important that these two parallel conflicts are important to U.S. security and U.S. democracy. Also in the package, Jonathan, is going to be partners in the Indo-Pacific, notably Taiwan, as well as the U.S. southern border. The thinking here is that if you cast a wide enough net, you're going to be able to garner the votes to pass this, because we do know that there are some Israeli critics in the president's own party on the progressive left. But when it comes to aid for Ukraine, there's also a lot of issues regarding the Republican far right.
MH, thank you. Alongside Ollie Crook. Ollie, stay safe going into the weekend. Thanks for being with us all week. Let's continue the conversation. Crossmarks Victoria Fernandez, George Concarvis of MUFG. Victoria, this administration wants to issue more debt. What's the price of that debt going to be?
Jonathan, I think you know what we're going to see if there's more debt issued. We're going to continue to have this supply-demand issue when it comes to our debt. We noticed it in the auctions that we had last week. We had very poor 3-year auctions, 10-year auctions, and we saw rates move higher because of that. There's also this contingency in Congress that on the Republican side, we can't even get a Speaker of the House because there is so much controversy going on in regards to spending, some of that having to do with Ukraine. So bringing this bill in where it's not just support for Israel, but linking it with Ukraine, the thought of having more debt brought in is going to really cause yields, I think, to move higher. Once we hit that 5% threshold on yields, we're probably going to see some pain in the equity market. And Jonathan, it's not just those nominal yields, right? Real yields are at 2.5%. When we get to this level, that's typically where we end up having some kind of a policy mistake. You have a lot of cash flow into the short end of the curve. The Fed starts rethinking what they're doing. I think there could be a lot of volatility around this decision.
George, your take on that. Is this Fed going to be comfortable allowing real rates to continue climbing?
Look, Jonathan, the Fed is basically in a fog. It has kind of admitted that they've lost confidence on the short-term outlook, let alone the long-term outlook. I think a lot of that comes back to getting the inflation call wrong, and they really just want to get the job done, but they really run the risk of overdoing it. And I think they are in the process of overdoing it. And really, what's just left with is a market that's also lost confidence, especially in the bond market. We've seen some pretty big moves, and to me, it feels like a capitulation. At some point, there is a stability that comes into the bond market, but if supply keeps coming like this, I agree with Victoria.
George, bit of a chicken and an egg question here, so forgive me, but does this bond market need equities to sell off hard before bonds stabilise, or vice versa?
I do think that an asset allocation trade would help the bond market, but it's the worst timing of the year. This is the end of the year. Portfolios are not going to get rebalanced massively in November and December. This is going to be a 2024 trade. And so really, we're in this kind of less liquid, reduced balance sheet world with a lot of bonds coming to the market, both from primary and secondary. I mean, this is where I think we're going to figure out how high we can go.
It's really hard to get a clear indication of anything right now, Victoria. You look at the data, tons of broad-based strength in retail sales this week. You listen to the companies. Bank of America says things are slowing. JP Morgan's hiking guidance. I mentioned LVMH and the airlines indicating the post-pandemic boom might be over. What can you glean? What can you take away from the earnings we've seen so far?
Well, I think we take away that we're still in that car with the clouded windshield. I don't think we have a clear picture of really where things are going. You have all of these unknowns and these uncertainties that are out there, whether it's political here in Washington, the geopolitical issues that we're facing, the economic numbers where some are good and some are bad, inflation not coming down as much as people want. I mean, there's all of these issues that I think are really kind of counterintuitive to each other. And so it leaves you in a spot, and it leaves the Fed in a spot of saying, well, how do we approach this? What do we do with our portfolios? What is going to happen in the marketplace? And I think it's where, as investors, and what we're doing with our clients is you have to take a step back and say, let's look at this from a longer term perspective. Let's build some barbells into the portfolio on the fixed income side and capture some rates on the short and long term. When you look at equities, have a little bit of cyclicality, trim some of those other names, have some staple exposure in there. I don't think you can have a clear path at this point in time to take a huge bet on the market. I think you have to kind of buffer that a little bit at this point.
I can hear people itching, George. They're itching to buy the recovery to the recession we haven't had yet. I've heard it so many times over the last few months. You're hearing the same thing?
Look, I mean, bond investors had a really tough year for the third year in a row. And this actually is a worse year because you had that big rally in the beginning of the year, got people kind of trapped longs at the low rates, which kind of gave a leg to the housing market and to equities. This low rates that we had all the way up through the middle of the summer kind of then flipped with this big, massive bear steepening, which I've been discussing for months now. I mean, the bear steepener is what gets you. It's very grisly. It's very rare. But when it comes, it doesn't really leave anything in its wake. So the bear market in bonds is what we have to focus on. It's getting attractive. The risk reward is getting there, especially in mortgages. But, I mean, it's too convex, rate vol is way too high to get involved here.
It's brutal. Think about where the curve has been. Negative 110 basis points back in spring. Right now, 210s, negative 16. The best steepening we've seen over the last couple of months. Just phenomenal. Victoria Fernandez, George Goncalves, to the two of you, thank you. Coming up, the morning calls, and later, Alpine's Sarah Hunt expecting stocks to struggle in a higher for longer interest rate environment. That conversation a few minutes away. 4 minutes away from the opening bell. Let's get you some morning calls. First up, Deutsche Bank upgrading Union Pacific to buy, pointing to a number of improving trends within the rail space. Next up, Redburn Atlantic downgrading Yum Brands to neutral, noting headwinds to the company's earnings growth outlook. And finally, Wolfe Research upgrading Morgan Stanley to peer perform, seeing limited downside after falling 8% since reporting results. Coming up, big tech earnings ramping up with FANG stocks next. That conversation coming up with Sarah Hunt of Alpine Saxon Woods. Your opening bell just around the corner. Seconds away from the opening bow this morning. Good morning to you. Heading towards a week of losses on the S&P 500, snapping a 2-week winning streak. Right now pulling back by about 0.1% on the S&P. On the Nasdaq, we're negative by 0.16%. The opening bow in New York rings. There we go. Switch to the board and get to the bond market. Yields look like this. We're down about 5 basis points on a 10-year to 493.71. Cycle highs this week. 2-year, 5-year, 10-year, 30-year. What a week it's been in the bond market. Even with this move lower, this week the 10-year yield higher by more than 30 basis points. In the FX market, the euro going nowhere. 105.84 unchanged on that currency pair. Crude going somewhere. 2 weeks of gains. Back into the 90s on WTI, up by 0.9% this morning. One stock to watch at the open, Amex, reporting record Q3 profits. The CEO saying this: the investments we have made in our value propositions are driving brand relevance across generations. Abby has more. Hey, Abby.
Hey, John. And yes, so there's the good part of the quarter, which is basically the surface. They did beat top and bottom line estimates, record profits, as you just mentioned. And that really has a lot to do with demand for their premium products, such as the Platinum card, along with the travel Gold card. Now, speaking of travel, that's what's driven a lot of their business over the last couple of years, that revenge travel coming out of the pandemic. What that creates, though, what investors don't like, with the stock now down 3.4%, is the fact that it's tough comps. The growth does not look as attractive for American Express, given the fact that this is going on relative to the strong revenge spending. So growth in spending on the cards is slowing. It's making those unfavorable comparisons. Plus, their total network volume, while up 7%, that missed estimates. It's the lowest growth in 10 quarters. The stock on the year into today up a little bit. Right now, we're looking at the stock near session lows, down about 3%. That, of course, is the worst day in a bit of time here. And it's trading sideways, John, in a range between 140 and 180. Investors can't figure out what to make of American Express.
145.40 right now. Abby, thanks for that. Let's stick with banking. Regions Financial falling short of Q3 earnings estimates. The CEO with this line: while the industry continues to face economic and regulatory uncertainty, we're confident in our ability to adapt to the changing landscape. Shanali has this story. Hey, Shanali.
Good morning, John. When you look at the regional banks, Regions Financials is just one of those banks that have already been down more than 20% on the year. And now not only is their net interest margins missing expectations, you also have their outlook starting to concern investors, with Evercore ISI saying that it's a net negative, this outlook that they have, likely pressured on the NII and net interest margin miss, and greater pressure than expected on funding costs, expense noise, and all that mounting credit pressure. They're one regional bank among many that are facing such problems, and you see that in the stock this morning, down another 12%. If you take a look at the KBW Bank Index, you're looking at most banks in the index certainly down. Really only JP Morgan Chase that is up anymore year to date at more than 8%, but everything else is down from 0.2% to 54% if you look at First Horizons. Not bad news everywhere. Take a look at Western Alliance really quickly here. It's getting just a little bit of a lift here on that beat. I'm sorry, everything is a miss these days. The beat that they had in net interest income. So you are seeing banks still trying to lend into this environment and also beat on credit costs, but it is a messy story among the regionals, and that continued pressure is still of great concern for credit markets.
Shanali, help me frame this. Is it JP Morgan versus everybody else, or is it the large banks versus the small banks still?
Can you say both somehow? At the end of the day, JP Morgan is just so big, and you see that in the bid that it's getting in the stock market. Its price to book ratio, it's trading at more than 1.5 times its book value, and almost everything else is starting to trade below. A really difficult moment for the banking industry here, John.
Huge gap opening up this year. Shanali, thanks for that. Thanks for the update. The latest on the financials there, the regionals specifically. Let's turn to the transports. Knight-Swift Transportation topping profit and revenue estimates. The CEO with this line: we remain excited about the future of this business and continue to work on growing organically and through strategic opportunities. Katie on top of this story. Hey, Katie.
Hey, John. Well, there's a lot to be excited about. You look at the stock market right now. Knight-Swift is soaring at the moment, up almost 12% or so. And let's get into some of the numbers here, because it really was a beat across the board. You take a look at third quarter adjusted EPS. It came in at about 41 cents. Analysts had been looking for 36 cents. You also saw total revenue beat as well, just above $2 billion. The estimate there was for $1.9 billion. And looking forward, Knight-Swift also narrowed its adjusted earnings guidance for the year. That topped the average analyst estimate in the process. Now, the sell side opened these numbers with open arms. You take a look at JP Morgan. They upgraded the stock to neutral, and their reasoning there was that the U.S. Express acquisition is making progress sooner than expected. Morgan Stanley, meanwhile, reinstated the stock as a top pick, and that's actually lifting industry peers as well. You take a look at J.B. Hunt and C.H. Robinson rising alongside Knight-Swift right now.
Katie, thank you. Thanks for the update. Look out for Katie later at the close with Remain Bostic. Looking at that name, this name on my screen right now, Tesla. Tesla yesterday with a really difficult session, down by more than 9%. Biggest one-day loss since July. The latest news on Tesla for you this morning, recalling over 4,000 Model X vehicles in China due to brake issues. This according to a statement from a Chinese regulator saying the following: the alarm may not be issued when the level is low. In extreme cases, it may affect the vehicle's braking and increase the risk of collision. Ed Ludlow with the update. Morning, Ed.
Yeah, good morning, Jonathan. Tesla down 2.4%, extending its declines. This puts Tesla on track for its biggest weekly drop of 2023, the worst week of the year. A lot of that downward pressure continues on from Wednesday night in that quarterly earnings report, where there was a top and bottom line miss, reiterating guidance that it will deliver 1.8 million units this year, or produce 1.8 million units this year, but much bigger macro concerns. As it relates to the China recall, this is a soft recall in the sense that those more than 4,000 vehicles that are impacted, the solution is an over-the-air update fix, which is a pretty commonplace occurrence when it comes to so-called recalls out of China that are mandated by the regulator. But, you know, the story has really changed, right? Elon Musk really focusing on the rates narrative, the macro environment that Tesla is operating in. And now there is a concern that the lever of price cuts that they've used to drive growth, which the target is 50% annual growth for Tesla, it won't work going forward, and it's not going to be the same sort of effective lever. And if you go on ANR on your Bloomberg terminal, it's just interesting to see on a 12-month price target basis trajectory change and where analysts see this stock going right now.
Ed, this just isn't a Tesla story. It seems to be the whole sector. I hear a lot of reports about EVs, unsold EVs piling up. Ed, what's happening?
Yeah, I think especially if you read our own Bloomberg Intelligence analysis, there is now a question mark over how robust consumer EV demand is, right? And I think that the story that will be increasingly written is that those early adopters, those most inclined to transition to an electric drivetrain, may have done so. How do you take the rest of the market? You know, the way that it gets explained to me by investors and market participants is like, a car is the most expensive thing you'll buy in your lifetime apart from a house. And the rate environment impacts that. Financing of those cars impacts that. And even though prices have come down, largely driven by Tesla's price cut initiative, it's still elevated for a battery electric vehicle relative to a combustion engine car for most middle income households, particularly in this country, John.
It's too expensive. Ed, thank you, sir. The latest on autos. Let's talk about houses as well. We put out this story yesterday. Home buyers needed a $114,000 salary to afford a typical home in America in the month of September. This assumes a 7.2% mortgage rate, if you can find one that low, with 20% down on a median price home of something a little north of $400,000. This according to real estate brokerage Redfin. To comfortably afford a home payment, this is the basic assumption, a buyer should spend no more than 30% of their income on housing costs. So let's go back to what this used to look like. Think about back in, say, 2012. The average requirement was roughly $38,000 to access the average home. It is now six figures, $114,000. Salary. Is it any surprise that people can't afford the EVs that are coming to market? Let's talk more broadly about the broader financial markets. Sarah Hunt of Alpine Saxon Wood seeing a challenging road ahead for equity markets, writing this. A higher for longer rate environment risks the repricing of assets after more than a decade of zero rates. It seems very unlikely that repricing would be to the upside. Sarah Hunt, I'm pleased to say, joined us right now. Sarah, let's talk about what companies are saying about this economy and who's got pricing power. We just talked about Tesla cutting prices. Yesterday, Netflix, we could talk about them hiking prices. Sarah, who's got pricing power right now?
Very uneven across different sectors. And I think that this is part of the problem and part of why people are having trouble figuring out what happens into next year. I would argue that it's going to be a challenge to think that you can get a 12% earnings growth for the entire S&P. I think there are some places where you will get it. I think you've seen some pricing power in some of the technology sectors. I think you've seen it in some places, but higher interest rates really takes a bite out of that pricing power, especially when you're talking about high-ticket items.
It's so difficult to get a read on discretionary spending right now, particularly given the example I just gave. But if you throw in what we heard from LVMH saying that they've seen the post-pandemic boom, it's over. What the airlines have indicated this week, American Airlines again. Sarah, where do you see that strength for the consumer at the moment? I see it in retail sales, but at the sector level, at the stock level, where do you find it?
I think you have to look at some of the smaller budgetary items, because think about that. I mean, what just happened with American Express too. I mean, we're saying we've got really good numbers and everything's going really well, but you're seeing a drop in that growth of travel spending and some of those expensive items. I think that's really the problem. Some of your tech stalwarts, are you still going to buy an iPhone? You probably are. Are you going to take an extra vacation? You might not. I think that there's going to be a real change in the way that we've been acting, and how to predict that change is obviously one of the biggest challenges that we all have right now.
Well, the consumer for most of this year, as you know, Sarah, has been surprising to the upside. I've called it the 3-month rolling recession call. We just keep pushing it out. Barry Bannister of Stifel was on a program earlier this week. He was talking about the slowdown coming. Guess when? Back half of 2024. Is the bigger risk for you, Sarah, that that slowdown comes sooner or it gets pushed out later?
I think the biggest risk is that we have this not just the rolling recession call, right? It's also the rolling what's going to happen with interest rates call. The chart that you put up earlier when you were talking to Mohammed Al-Arian, where it looks like we have 1 or 2 more rate hikes and then all of a sudden we see rates come down dramatically. The market's also been pricing that combination of we're rolling out a recession, we're going to have rate cuts. And I think that the strength in the consumer has had, and the labor markets has had this effect that has allowed companies to continue to earn. The question really is, when do those margins start to get hit? And that has been the magical question. And so far, no one's actually nailed the timing of it completely right. But I think that you do start to see some weakness. You're seeing it now in the way that companies are talking about their forward numbers on their third quarter calls. And I think that as we get through this earnings season, we're going to see some projection of that. Although I doubt you're going to see anybody who wants to tackle what they're going to look like in 2024.
Let's work through the market right now. What's playing out on the screen? The 10-year yield lower by 6 or 7 basis points, pulling back from multi-decade highs at the front end. We were through 520 early this week. We're down 5 basis points this morning to about 5.1% on a 30-year. The 2-year is basically where the 30-year is right now. The 30-year is at 5.077%. That yield's lower by about 3 basis points on the session. That's the bond market. About 12 minutes into the equity market session, we're negative by just 0.1% on the Nasdaq. On the S&P 500, virtually unchanged. If you're looking at crude, back in the 90s, Sarah, WTI $90.30, up by 1% this morning. You've had a preference for energy for a while. Sarah, is that a place you want to stay?
I think it is. I mean, the really unfortunate thing is that what's going on right now in the Middle East only exacerbates the problems that you see in the energy sector. And I think that this consumer reluctance to get to the next level of EV vehicles, I think there's still challenges, and the hydrocarbons that people have been talking about phasing out over the next decade or so, I think are here to stay with us longer. And I continue to believe that energy is not a bad place to be. And I think that right now, unfortunately for everybody, that is coming to the fore in a geopolitical way as well.
Big combination with Exxon in the last couple of weeks, Sarah. Are you expecting to see more of the same from others?
I think you will. I mean, I think that, it's hard in the energy stance to say that all the acquisitions end up making sense. They certainly sometimes take a couple of years to play out. And I think that you are going to see that. I mean, this is all about efficiencies, right? In the end, there's also what's coming forward in the next year or two. Well, people are looking for ways to save money. Well, how do you do that? You combine into a bigger company, and then you can take some of the costs out. Look at all the announcements that are being made right now after Credit Suisse was absorbed. I think that there's going to be continuing merger and acquisition activity, because I think you have to be bigger to be able to navigate some of the cost structures and some of the political structures as well.
Sarah, great to catch up, to get the update from you, the team. Sarah Hunt there of Alpine Saxon Woods. If you're just joining us, we're about 13 minutes into the session. We are pulling back just a touch, no drama. We're down on the week, down just a little bit on the session by 0.1%. Coming up, some potential progress out of Detroit.
As the UAW strike against Ford continues, we are at a crossroads. This is about the future of the American automobile industry.
The UAW inching closer to a deal with General Motors. That conversation up next.
As the UAW strike against Ford continues, we are at a crossroads. Choosing the right path isn't just about Ford's future and our ability to compete. This is about the future of the American automobile industry. It should be Ford and the UAW versus Toyota, Honda, Tesla, and all the Chinese companies that want to enter our home market.
That was Ford Chairman Bill Ford speaking on Monday. Today, the union and GM moving closer to a tentative agreement, according to a negotiator. UAW Vice President Mike Booth saying this: all the pieces are there, we just have to glue it together. Attention now shifting to Union President Shawn Fain, expected to provide an update at 4 p.m. Eastern Time. Your team coverage begins right now with Bloomberg's Anne-Marie in Washington alongside David Welch over in Detroit. David, first to you. Are we close to a deal here?
Well, look, there's some operative words here in that story. First off, the headline, inching toward a deal. So they've probably got a few feet to walk, but they do need to glue all this together. I think Mike Booth is giving us the straight dope on that. The trouble with these labor deals is often it gets down to the wire, like, fairly close, like I think they are, and somebody wants something else, and that could take more time to iron out. Like GM still hasn't come to 23% pay increase over the 4 years. They're at 20%. Ford's at 23. I think they're going to have to do that. And Mike Booth also told us yesterday they still need to come to an agreement on retiree benefits. It sounds like it won't be a pension. It'll be a 401k, but a very nice one, and they still need to finalize numbers on that. And then, there's side letters on how they will handle future battery plant workers. I think they probably have a decent understanding there, but then once the attorneys get in and the specifics happen, these things can take a bit more time. But this is the most positive commentary we've heard from either side about this probably the entire time, because there's been a lot of nasty rhetoric for the last 5 weeks.
True. Excuse the pun, but how much gas is in the UAW tank? Can they afford to drag this out much longer, David?
Sure, they haven't actually spent all that much because they're really only striking a small number of plants and a relatively small number of workers. They had about $825 million going into this. They could have struck every plant at all three companies for 7 weeks, and they've spent far less than that. It's been 5 weeks at just a relatively small number of facilities. So they've got money to continue this.
What would trigger an escalation for them, David? What do you think it would be? We heard about the F-Series plant being targeted. What would be the escalatory move from UAW now for these three automakers in Detroit?
I think when Sean Fain takes the Facebook Live event at 4 o'clock, if there are just a few things that he really wants, and he's not getting exactly what he thinks will move the needle, then he could put up some last-minute pressure by walking out at some other plants. When Mike Booth says the pieces are there, but they need to be glued together, I think there is a general framework, and that the union has, as Ford has said, pushed the companies almost as far as they can in terms of what they are willing to spend on this 4-year labor agreement. But at the last minute, the union can apply pressure to try to squeeze a little bit more out of the companies, and with a lot more in their strike fund to do it, I think they could.
MH, a good reason for this White House. This story's fallen off the radar. Where's it going?
Well, Jonathan, I think if there's able to be an agreement, that's going to be welcome news for this White House. They want to see a fair agreement for the unions, but obviously, of course, they'd like to see this be done and finished with so they can move on, because the concern is that this can cause a recession in a place like Michigan. I also like to note, Jonathan, I was pretty struck by some of the numbers we saw yesterday in the Bloomberg News Morning Consult poll. While Biden does hold the union vote still overall, he beats Trump by 11 percentage points. Look at these pockets in some of these swing states like Arizona, Pennsylvania, and Wisconsin. Trump is eating at those voters. So for President Biden, this shows to me, yes, he wants to be the most pro-labor union president in modern history. We all know the slogan, but it does look like he still has some work to do.
To your point, does he have the union vote, Anne-Marie? And if he doesn't, does the former president have it?
Well, that's a great question. At the moment, according to our poll, overall, he has the union vote. But the issue is that former President Trump is starting to eat away. He is starting to gain favor with some of these union households. Look at a place like Michigan. Our poll shows that Biden holds the union households by 11 percentage points in Michigan. In 2020, John, when he won Michigan, he had about 25 percentage points of those union households. That's less than half. So it shows to me that the president has a lot of work to do, and also potentially being the most pro-labor union president isn't necessarily top of mind of these voters. What is top of mind of these voters is inflation and the fact that they feel like their wages are not keeping up with the price of everyday goods like groceries and like gasoline, Jonathan.
MH, thank you. Alongside David Welch on the latest from Washington and Detroit, respectively, inching towards a deal between UAW and GM. As David Welch put it, maybe, sure, we're inching towards a deal, but we still have a couple of feet to go. If you're just tuning in about 23 minutes into the session, pulling back by 0.2% on the S&P. Let's get you some sector price action. Here's Abby.
Interesting sector action today, John, because we do have this small decline for the S&P 500, and yet more sectors are higher than not. And also interesting is with yields down, we have some of those rich dividend sectors on top: real estate, utilities, consumer staples. Toward the bottom, we do have energy, even with oil higher. On the week, we are, of course, talking about that first down week in 3, as you mentioned earlier, down about 1%. Two of the best sectors, energy and consumer staples, and then two of the worst sectors, real estate and discretionary. Most sectors, not surprisingly, on the week are down, again with the S&P 500 heading toward a 1% loss.
Abby, thank you. Up next, a sneak peek of next week, your trading diary coming up. stocks down just a touch on the session and on the week. We're down by 0.2%. That's the price action. Let's get to the trading diary. Coming up, the US-EU summit kicking off at noon Eastern from the White House. Plus, Fed President Mester speaking before the quiet period. Next Tuesday, earnings from General Motors, Alphabet and Microsoft. Wednesday, Meta and IBM. Thursday, more results from Intel and Amazon. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. I'll be away next week. I'll see you the week after that. This is Bloomberg.